Welcome to Safe, Simple Sound Tax Edition. I'm Alex, your host, and I'm joined by Sam, our tax expert, and Taylor, who asks the questions you might have on your mind. Together, we break down complex tax topics into clear, actionable insights. We use AI enhanced voices to deliver consistent, high quality content while keeping our focus on what matters most, helping you understand your taxes. In each episode, I'll guide our discussion, Sam will provide expert analysis, and Taylor will make sure we explain everything in plain English. We're here to make taxes approachable, whether you're filing a basic return or dealing with more complex situations. But before we dive in, a quick note. This podcast is for entertainment only and does not constitute tax, financial, legal, or professional advice. Tax decisions should always consider your personal circumstances, filing status, and specific situation. All tax amounts, thresholds, and deduction values mentioned are examples only. Tax numbers change annually, and you must use the current official values from irs.gov when preparing your returns. Be sure to consult a qualified tax professional before making any tax-related decisions. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Let's get started. Today, we're diving deep into the crucial yet often overlooked world of tax record keeping. This episode is based on a helpful step-by-step guide from IRS Document Publication 17, which offers a wealth of information on everything from the types of records you should keep to what happens if you move after filing. The IRS document really emphasizes the importance of being organized, something we at Safe Simple Sound strongly believe in. Remember our S for Seize Financial Control? It also highlights how good record keeping can help you identify sources of income, track expenses, and ultimately support the items reported on your tax return. This can protect you from penalties and ensure you're paying the correct tax, hitting that C in secured, creating that financial safety net. We'll be unpacking this topic through three key areas. First, we'll tackle record keeping for tax purposes. We'll delve into scenarios like the freelancer's dilemma, exploring the challenges of organizing income from multiple sources, and the homeowner's renovation records, where we'll discuss how home improvements affect your cost basis. We'll also touch on the complexities of the investor's digital asset portfolio and how to keep track of those crypto and NFT transactions. Next, we'll move on to understanding tax refunds and interest. We'll explore what to do in scenarios like the delayed refund and the anxiety-inducing the erroneous refund, because who hasn't worried about getting back too much money from the IRS? Finally, we'll cover managing address changes with the IRS, focusing on the common scenario of moving after filing. It's all about that E in secured, embracing financial flexibility and adapting to life's changes. So grab your coffee, your notepad, and get ready to take some notes. This episode is packed with practical advice to help you embrace mastery of your tax records, another key element of our secured philosophy, so you can navigate tax season with confidence and peace of mind. Let's get started. Let's dive into a specific situation that can be tricky, the world of freelancing. Today's scenario, the freelancer's dilemma, focuses on the challenges freelancers face when organizing income and expenses from multiple clients, especially with the looming possibility of an audit. Taylor, imagine you're a freelancer juggling several projects. What comes to mind when you think about the essential records you'd need to keep for tax purposes?
Oh boy, that's a thought that keeps me up at night. I'd probably think about invoices sent, payments received, obviously. Then there's all the expenses, like software subscriptions, internet bills, maybe even a portion of my rent if I have a dedicated home office. But honestly, keeping track of it all feels like a mountain of paperwork. Is there a magic formula?
No magic formula, but there is a basic framework. The IRS isn't prescriptive about the format of your records, but they are clear about the content. You need proof of income and expenses. For income, this includes invoices, payment confirmations, and 1099 forms. For expenses, receipts, bank statements, and even canceled checks are vital. As the Publication 17 mentions, think of it as building a case to support the numbers on your tax return.
That's a great way to put it, Sam. Think of it like building a story. Every transaction is a chapter, and your records are the supporting evidence. Taylor, you mentioned the potential paperwork mountain. This leads perfectly into my next question. How can digital tools simplify this for freelancers?
This is where I get excited. There are so many apps and software programs designed specifically for freelancers. Some connect directly to your bank account and categorize transactions. Others let you scan receipts, generate invoices, and even track mileage. This reminds me of what we discussed earlier about the IRS accepting electronic records. That's huge for digital natives like me.
Absolutely. The IRS has embraced digital record keeping. As long as the digital system accurately reflects your financial activity and can be accessed for review if needed, it's perfectly acceptable. Just ensure your chosen method allows for long-term storage, as you may need these records for several years, as outlined in the article we referenced.
So, if I understand correctly, Sam, even if I use an app, I should back up my records regularly, right? Maybe even download reports periodically in case the app goes out of business?
Exactly. Think of your data like precious photos. You want multiple backups and safeguards.
Okay, final question on this scenario. What are the consequences if a freelancer's record keeping is inadequate?
Well, based on the article, it sounds like it could range from paying additional taxes to penalties, even if it's unintentional. The article mentions a 6-year period of limitations if you underreport income by more than 25%. That's a long time to have a tax issue hanging over your head. And not being able to substantiate deductions during an audit? Yikes.
Precisely. Accurate record keeping isn't just about avoiding penalties. It's about empowering you to accurately assess your financial position, plan for taxes, and make informed business decisions.
Excellent point, Sam. So let's recap. For freelancers, meticulously tracking income and expenses is non-negotiable. Leverage digital tools to simplify the process, but prioritize secure backups. And remember, inadequate record keeping can lead to significant financial repercussions. Our call to action today: organize your freelance income and expenses using a dedicated app or spreadsheet. And for personalized guidance, consult a tax professional. Now, let's shift gears from the freelance world and talk about another common record-keeping challenge: home renovations. This next scenario will explore how those improvements you make to your property can impact your taxes down the line. Just like freelancers need to track their income and expenses, homeowners also need to keep detailed records, especially when it comes to those exciting but sometimes pricey home improvement projects. In this scenario, we're focusing on a homeowner who's been diligently updating their property over several years. Think kitchen remodels, bathroom upgrades, maybe even adding a deck. They've invested time, effort, and money into these projects, but now they're facing a bit of a record-keeping puzzle. They're not entirely sure which of these expenses can actually be used to adjust their cost basis. That's the original price of the house plus improvements, and how these records will affect their capital gains tax if they decide to sell down the line. Sam, can you help us unpack this? Let's start with the basics. Which home improvement expenses are considered capital improvements for tax purposes?
Capital improvements are renovations that add value to your home, prolong its life, or adapt it to new uses. Think of things like a new roof, replacing windows, adding a room, or installing a new HVAC system. These are different from repairs, which are generally for maintenance, like fixing a leaky faucet or patching a hole in the wall. Repairs are typically deductible in the year they're incurred, while capital improvements increase your cost basis.
So if I understand correctly, replacing my old, drafty windows counts as a capital improvement, but fixing a cracked window pane is just a repair?
Exactly.
That's a great clarification, Taylor. Now, how can homeowners effectively track and document these renovation expenses?
The key is detailed record keeping. Keep every receipt, invoice, contract, and even canceled check related to your renovations. Include details like the date of the work, description of the project, and the contractor's information. Digital tools like spreadsheets or dedicated home improvement apps can make this much easier.
This reminds me of what we discussed about freelancers using apps. It seems like good organization is crucial no matter what your tax situation is. What about taking pictures of the work as it progresses? Would that be helpful?
Absolutely. Visual documentation can be very valuable, especially for larger projects.
Excellent point. Now, for the long game, how long should homeowners keep these records?
According to the IRS, you should keep records related to property until the period of limitations expires for the year in which you sell the property. This is generally 3 years after the sale. But there are exceptions, as detailed in the article we've linked in the show notes. However, because these improvements affect your cost basis, which carries over from year to year, it's often wisest to keep these records indefinitely, or at least until you sell the property and are sure you won't need them again.
So to recap, capital improvements increase your cost basis, impacting your capital gains when you sell. Meticulous record keeping is vital, and digital tools can help. And remember to hold on to those records, potentially indefinitely, to avoid headaches down the line. Gather all your receipts and invoices related to home renovations. Don't wait until you're ready to sell. And most importantly, consult with a tax advisor. They can help you understand how these expenses affect your specific situation and help you minimize your tax liability when you eventually sell your home. So, Taylor, we just talked about keeping records for home renovations, which can get pretty complex. But imagine adding another layer of complexity: digital assets. This brings us to our next scenario: the investor's digital asset portfolio. Our listener this time is an investor juggling stocks, cryptocurrencies, and NFTs. They're feeling a bit lost in the digital weeds, unsure how to track their cost basis, transaction details, and other crucial info for accurate tax reporting. And who can blame them? The regulations around digital assets are constantly evolving. Sam, Taylor, let's dive in. My first question is, what are the specific record-keeping requirements for digital assets like cryptocurrencies and NFTs?
Alex, the core principle is the same as with traditional assets. Maintain comprehensive records to substantiate your tax filings. For digital assets, this includes the date of acquisition, the cost basis, what you paid, the date of disposal, when you sold or traded, and the proceeds from that disposal. For NFTs, you also need details about the creator, the platform where it was purchased, and any associated metadata.
So if I bought Bitcoin on multiple occasions at different prices, I need to track each purchase separately? That sounds like a headache.
Exactly. This is where things can get tricky, especially if you're active on multiple exchanges. Each transaction needs to be documented to calculate gains and losses accurately.
That leads perfectly to my second question. How can investors effectively track transactions across different platforms and exchanges?
Thankfully, there are several tools available. Spreadsheet software can work, though it requires meticulous manual entry. Dedicated cryptocurrency tax software is often a better option as it can integrate with exchanges, automate transaction imports, and calculate cost basis using different methods like FIFO, first in, first out, or LIFO, last in, first out.
FIFO and LIFO. This reminds me of what we about inventory management. So the same principles apply here?
Precisely. The way you choose to account for your asset sales impacts your tax liability.
That's a great connection, Taylor, and brings us to the final question. What are the tax implications of different digital asset transactions? Buying, selling, staking, for example.
Buying itself is not a taxable event. Selling, as we've discussed, triggers capital gains or losses. Staking, where you essentially lock up your crypto to earn rewards, is generally treated as income and needs to be reported in the year you receive it. The IRS considers staking rewards similar to interest. NFT transactions, whether buying, selling, or creating, each have unique tax implications too.
This is a lot to keep straight. So if I understand correctly, even seemingly simple actions like staking can have tax consequences I might not have considered.
Absolutely. The IRS is increasingly focused on digital asset taxation, and accurate record keeping is paramount to avoid penalties.
So, to recap, meticulous record keeping is essential for digital assets. Track every transaction, utilize available tools like cryptocurrency tax software, and remember that different transaction types have different tax implications. Don't forget, Taylor, that good record keeping not only helps you stay compliant, but also helps you understand your investment performance better.
Right. It's not just about avoiding trouble. It's about having a clear picture of my overall financial position.
Exactly. To learn more and take control of your digital asset record keeping, explore specialized cryptocurrency tax software and definitely consult a tax professional knowledgeable in this area. They can provide personalized guidance based on your specific situation and help ensure you're reporting accurately. So, as we've seen with freelancers, meticulous record keeping is crucial. But what happens after you've diligently filed your return and you're expecting a refund? That's what we'll explore now. Today's scenario focuses on a common taxpayer experience: the delayed refund. Imagine you've filed your tax return on time. Everything seems in order, but weeks go by and your refund is nowhere to be seen. This can be frustrating, especially if you're relying on that money. Our listener, let's call her Sarah, is in this exact situation. She's filed on time but hasn't received her refund after several weeks. She's unsure how to check on its status or what steps she can take. Sam, what are some of the common reasons why a refund might be delayed?
Several factors can cause delays. Simple errors like an incorrect social security number, bank account details, or even a misspelled name can cause the IRS to flag a return for review. More complex issues like claiming certain credits or deductions that require additional verification can also lead to processing delays. Sometimes returns are chosen randomly for additional review, which can also extend the time frame. Finally, high filing volumes, especially during peak season, can simply overwhelm the system.
So, if I understand correctly, even a small typo could hold things up? That seems a little stressful. This reminds me of how important record keeping is, like we discussed in the last segment. Good records might help clear up any discrepancies quickly.
Exactly, Taylor. Having accurate records can indeed expedite the resolution process if there's a discrepancy. Now, let's say Sarah suspects her refund is delayed. Sam, how can she check on its status?
The IRS offers several convenient ways to track refund status. The quickest and easiest is through the Where's My Refund tool on irs.gov. There's also a handy IRS To Go mobile app. Both require the taxpayer's social security number, filing status, and the exact refund amount. Alternatively, taxpayers can call the automated refund hotline.
So let's say Sarah checks the website or app and sees her refund is delayed. What are her options then? What recourse does she have?
First, she should verify the information entered is accurate. If there's an error on her part, she might need to amend her return. If the IRS system shows the refund has been issued, but she hasn't received it, she should contact her bank to confirm the deposit. If everything seems correct on both ends and the delay is significant, say beyond the typical 21 days for electronic filing, then contacting the IRS directly becomes the next step.
A good point, Sam. Sometimes it's a simple logistical issue. Let's recap quickly. Common reasons for delays include errors on the return, additional verification needs, random reviews, or high filing volume. Taxpayers can track their refund status online, through the mobile app, or by phone. If a significant delay occurs, contacting the IRS directly is the best course of action.
This is super helpful. Knowing these steps and resources will definitely reduce anxiety for taxpayers like Sarah. It's definitely better to be proactive and check than to just wait and wonder.
So remember, if you're expecting a refund and it's delayed, don't panic. Use the IRS website or the IRS To Go mobile app to check your refund status. If you encounter any discrepancies or significant delays, don't hesitate to contact the IRS. Being informed and proactive is the best way to manage your tax refund. So Taylor, we just discussed the frustrating situation of a delayed refund. But what if the opposite happens? What if you get a refund that's significantly larger than you anticipated? That can be just as concerning, right? This is what we'll be exploring in our current scenario, the erroneous refund. Imagine opening your mailbox to a refund check that's way more than you expected. It might feel like winning the lottery, but it's crucial to understand the implications. Let's dive in with our expert, Sam. Sam, what's the first step someone should take if they receive a refund that seems too large?
The absolute first step is don't spend it. It's tempting, I know, but that money might not actually be yours. The IRS makes mistakes sometimes, just like everyone else. The next step is to compare the refund amount with your tax return. Double-check your calculations and make sure the refund matches what you calculated you were owed.
So, if I understand correctly, even if it feels like a gift from the tax gods, I should resist the urge to book that vacation and instead verify the amount against my own records. This reminds me of what we discussed earlier about keeping good records. It really pays off in situations like these.
Exactly, Taylor. Excellent point. Now, Sam, what are the potential consequences if someone does spend an erroneous refund?
The IRS will eventually notice the error and ask for the overpayment back. This can happen months or even years later. They'll also charge interest on the amount you owe. As our reference article mentions, some of the interest might be forgiven, especially the portion accrued before the IRS contacts you, unless you or someone related to you caused the error or the overpayment is substantial, over $50,000.
That makes sense. So it's not free money, it's more like an interest-bearing loan you didn't ask for. What if the amount is relatively small, say a few $100s? Would the IRS really pursue that?
Yes, they likely would. Even small amounts add up, and the IRS has systems in place to track these discrepancies. Ignoring it could lead to bigger problems down the line.
Right? It's like a library book. Eventually, those overdue fees catch up with you. Let's say someone realizes they received an erroneous refund. What's the best way to communicate with the IRS about it, Sam?
The best way to handle an erroneous refund is to contact the IRS directly. You can call them or write a letter explaining the situation. Include a copy of your return and the notice you received about the refund. The IRS website also provides guidance on how to handle overpayments. Being proactive and transparent is key.
So, reaching out to the IRS is crucial. It's like admitting you accidentally took an extra item from the grocery store, self-checkout. Better to address it head-on than to wait for them to come looking for you. I appreciate that clarity, Sam.
Great analogy, Taylor. Let's recap. If you receive a larger than expected refund, don't spend it. Verify the amount against your return, and if there's a discrepancy, contact the IRS immediately. This proactive approach can save you from interest charges and potential penalties down the road. So, Taylor, we just talked about what happens if you receive an erroneous refund. Definitely a situation you want to avoid. But life throws curveballs, and sometimes things change after you've already filed. That brings us to another common scenario: moving after you've submitted your tax return. Imagine this: you filed your taxes, anticipating your refund, and then you decide to move. Suddenly, you're worried about your refund getting lost in the mail. This happens more often than you might think, and today we're going to explore how to navigate this situation.
It's a great topic to discuss, especially with moving season often coinciding with tax season.
Absolutely. Now, Taylor, let's say you're in this situation. What would be your initial concerns?
Well, my first thought would be, how do I even tell the IRS I've moved? And then, of course, I'd be panicked about my refund. How can I make sure it gets to me?
Perfect questions to start with. Sam, what are the different ways to notify the IRS of a change of address?
The IRS offers a few ways to do this. You can use Form 8822, Change of Address, which is probably the most official method. You can also notify them through their website, irs.gov, or even orally, although I would recommend a written or electronic notification for documentation purposes. Our reference article mentions Revenue Procedure 2010-16 for more details on this.
So if I understand correctly, using Form 8822 is like sending a formal letter, while the website option is more like sending an email.
That's a good analogy. The key is to provide clear and concise notification, regardless of the method.
How about ensuring the refund gets to the new address, Sam?
Besides notifying the IRS, it's crucial to also notify the post office serving your old address. They can forward your mail, including your refund check, to your new address. This is particularly important if you didn't opt for direct deposit.
I wonder if setting up direct deposit would simplify things. Setting that up would bypass the whole mail forwarding issue, right?
Exactly. Direct deposit is the most efficient way to receive your refund, and it's generally safer too.
And Sam, what are the potential complications if someone forgets to update their address with the IRS?
Several issues can arise. You might miss important notices regarding your tax account, potentially leading to penalties or interest charges. It can also complicate future filings and communication with the IRS. Beyond just refunds, the IRS sends important notices throughout the year, and you need to receive those.
So, it's not just about the refund, it's about maintaining accurate communication with the IRS for all future correspondence.
Precisely.
Let's recap quickly. We've learned three key things. Notify the IRS of your address change using Form 8822 or their website. Inform the post office to forward your mail, and understand that keeping your address current is vital for all communication with the IRS, not just refunds. Use Form 8822 or the IRS website to update your address with the IRS. Notify the post office as well to forward your mail. This simple step can save you a lot of headaches down the road. And that's a wrap on our deep dive into the world of post-filing tax essentials. We covered a lot of ground today, drawing from the IRS publication 17, What Happens After I File. We explored the crucial importance of maintaining thorough records. Whether you're a freelancer juggling multiple clients, a homeowner tracking renovation expenses, or an investor navigating the digital asset landscape, remember those S and C's in secured. Seize control and create that safety net. We also discussed the ins and outs of tax refunds and interest, addressing those nail-biting scenarios like delayed or erroneous refunds, and the importance of keeping the IRS updated on your address, especially after moving, embracing that E for financial flexibility. I particularly hope our discussion on digital asset record keeping resonated with you, as it's an increasingly important area for many investors today. And don't forget those tips on how long to keep different types of records. That information could save you a lot of hassle down the line. Thank you for joining me today on Safe, Simple, Sound Tax Edition. Check out the show notes for all mentioned resources, including IRS sources and helpful tools. If you found value in this episode, please leave a review and share it with someone looking to better understand their financial choices. This is Alex, wishing you safe, simple, and sound financial journeys.